So a bit of dollar weakness is what we're seeing today, and that's because the dollar's had a very good run recently. Do you think it's just a bout of softness in an overall bull market?
Well, exactly. I think the real issue here is basically what's going on in the Eurozone versus the US around monetary policy. The market's been reassessing its views there with regard to what the Fed in particular will do next after what sounded like to me a pretty neutral statement by Bernanke earlier in the week, which the market then took slightly differently. I think exaggerated some of the shift in tone there. So it's really back to fundamentals in the terms of those currency moves. But the rand, actually, we've seen people taking off some of their punts, particularly in euro ZAR, and hence some of the large moves yesterday in particular. But all eyes definitely looking ahead now to next week, and the CPI number for the rate outlook is what the market will turn to next.
Okay, so I'm also looking at the way the local currency has been performing, because we've also seen quite a bit of weakness for the rand, Peter. I mean, was this surprising to you? A lot of the investment banks here in South Africa have been talking about a much stronger local currency.
Well, the view definitely is for a stronger currency over the whole year, but a lot of people had these short euro ZAR, in particular, short dollar ZAR trades on, and they felt that it was time to take profit on that, seeing some stronger dollar coming through, as you said before, and hence the large move up we saw yesterday in particular. Stops were triggered, they moved pretty quickly. We can well see a bit more weakness, I think, in the week ahead or so. But the overall picture for the year, which I subscribe to as well, of a stronger currency, is still very much intact on flows into emerging markets and South Africa.
So, Peter, we had quite a nice bond auction coming through for Spain, 3 billion euros worth sold. And then we also are very worried about the overall unemployment scenario that's happening. What is the word on the ground, Peter? Do you think that things are going to start looking to the upside going forward? Is this the bottom in Europe?
Well, in terms of simply looking at sort of export demand globally and what is happening domestically in the Eurozone with regard to consumption, there's still actually further to go in our own forecast. We see basically the trough happening in Q2 for demand. But really what it's turning out to be is a slightly shallower recession, a slightly shallower dip down in the Eurozone economy. Of course, those issues are still there, as you said, around unemployment, things like that, but it's definitely looking slightly better. We're revising up our forecast as a result of these moves in Europe to around flat 0% before we were around minus 0.7. So it is looking more positive, but you're right, the underlying picture is still there, and especially in terms of resolving the fiscal difficulties in periphery Europe, and with regard to Portugal, which is seen as the next possible case for PSI.
Okay, so when you look at what's happening in emerging markets, because there's a lot of talk about possible monetary policy easing, India didn't do it today, keeping rates unchanged at 8.5%, perhaps slightly worried about the inflation outlook. No real move coming through from China as yet either. What is your perception with regards to the health of the emerging market space?
Well, I think emerging market central banks have had a pretty difficult time recently. If you think about worries still about lower growth, both globally and domestically in several markets, perhaps slightly backward looking from central bank perspective compared to the market, which should perhaps run ahead of itself, getting a little more optimistic. But at the same time, you've seen oil prices move up, has been provided some concern as well. So it's really a juggling act. This is the hardest point, if you like. It was much easier to be cutting rates or moving rates last year when the picture was much more bearish around global growth. So I think most central banks, and South Africa included, needs a further shock to the downside in growth before we can see any meaningful additional moves in rates.
Okay, well, I mean, are you pro then more rate cutting to try and boost growth at a risk that inflation could rise, Peter?
Well, I think it very much depends on a country-by-country basis, right? In most places, core inflation is actually broadly under control. In Eastern Europe, where the oil price increases are already starting to filter through, core hasn't really moved yet. So it's still a bit early, perhaps, to be talking of rate cuts. We need to see what's going on. Is there any pass, or are there any second-round effects to core inflation in emerging markets coming through, with generally, demand is looking more positive than we thought, but we should still remember there are output gaps overall. The likelihood of those second round effects probably is somewhat limited. So I would say I sit on the fence for the time being around decisions of if central banks in the end should be cutting or not.